In this explainer, we are diving into a challenge that, let's be honest, affects every single one of us, the future of retirement. You might think of it as a quiet crisis, this kind of slow motion problem, but it's about to hit with the force of a tidal wave. So let's just start with one number, a single, really stark number that's going to set the stage for this whole story. 2035. So what's so special about 2035? Well, that is the year the U.S. Social Security trust funds are projected to be completely depleted. And look, that's not some far-off abstract future, right? It's just over a decade away. And I want to be clear, this is not just a U.S. problem. For major economies all around the world, the clock is ticking, and the deadline to defuse this thing is coming up fast. So what's behind all this? At the heart of it is this powerful global trend that people call the demographic time bomb. I like to think of it as a scissors effect. Imagine a pair of scissors, right? Two blades moving in opposite directions, and they're about to cut right through the fabric of our social safety nets. Okay, let's break that down, this scissors effect. One blade is that people are living longer, healthier lives. And that's fantastic, right? But it also means more people are drawing retirement benefits for way longer. Then you've got the other blade. Birth rates are falling. That means fewer young workers are coming up to pay into the system. More people taking out, fewer people putting in. It's a simple but pretty brutal equation. And you can see this squeeze happening right now in the US. I mean, think about this. Back in 2003, you had about 3.3 workers for every single retiree. By 2030, that number is expected to drop to just 2.2. That is a huge strain on the system's ability to keep paying out benefits. And as the UN points out, this is absolutely a worldwide thing. Falling birth rates, people living longer, it's reshaping societies everywhere. And some countries, believe it or not, are facing an even more extreme version of this future. Okay, let me give you another number that just really puts this into perspective. 79. For this, we have to look at Japan, which kind of gives us a glimpse into the absolute upper limits of this demographic strain. Yeah, you heard that right. By 2050, Japan is projected to have almost 80 retirees for every 100 workers. Can you even imagine that? A society where pretty much every single working person is supporting a retiree? A ratio that high puts this, just immense, almost unbearable pressure on the old-school pension systems. All right, let's shift gears and look at China. It's a country that's aging at an absolutely incredible rate. Now, they've tried to get ahead of this by building this more complex three-part pension system, but, well, the story there has a really crucial lesson for all of us. On paper, it's a really solid approach. You've got Pillar 1, which is the basic state-run safety net. Then Pillar 2 adds a layer from your employer. And Pillar 3 is all about personal savings. The whole idea is to spread the risk, Diversify, so no single part of the system has to carry the entire load. But, and this is a big but, in reality, the system is just dangerously out of balance. That first pillar, the state-run one, it's carrying almost the entire burden. We're talking 90%. The other two are just tiny, severely underdeveloped, partly because people don't trust them, there are regulatory hurdles, you name it. And the result is the whole public system is just cracking under the strain. So to try and ease this pressure, a lot of countries are turning to this strategy called financialization. Basically, the idea is to take these giant pools of retirement money and invest them in the stock market. Stocks, mutual funds, to try and get higher returns. But, as you can probably guess, this brings in a whole new set of trade-offs. We're talking risk versus reward. And when you look around the world, you see two really different philosophies for how to actually manage that risk. And this, for me, is where the whole debate gets super interesting. Okay, so this really gets to the core of it. On one side, you've got the US model. Think 401ks. The risk from the market is put squarely on you, the individual. Now that means you could get some awesome returns, but it also means a market crash right before you retire, what experts call sequence risk, could be absolutely devastating. Then, on the other side, you've got the Dutch and Nordic model. They pool everyone's money together to share the risk collectively. This approach also gets you professional management and economies of scale, which usually means more stable, if not always spectacular, long-term results. But this brings us to a really crucial question. What if just fixing how we invest the pension money isn't enough, It might be like rearranging the deck chairs on the Titanic. The fundamental problem, that there just aren't enough workers generating enough economic value to support all the retirees, that problem doesn't go away. So the real fix might need a much, much bigger strategy. It's not just about arguing over how to slice up the economic pie. It's about fundamentally growing the whole pie and growing it faster than our populations are aging.
And that's going to require a multi-pronged attack. We're talking about things like automatically tying the retirement age to how long we're all living, getting rid of mandatory retirement ages altogether, shifting to flexible jobs that pay for performance, not just seniority, removing barriers that keep women out of the workforce. It's really a complete rethink of how we approach not just retirement, but our entire working lives.
And here's the kicker from the OECD. The crucial point is this. You can raise the retirement age on paper all you want, but it's totally useless if the job market doesn't actually let older people keep working. So pension reform and labor reform, they have to go hand in hand. You can't have one without the other. But even with all those reforms, the demographic math is just relentless. It doesn't stop. To really, truly overcome this drag, we'd need a productivity leap so massive that it changes the entire equation. And that's where the ultimate wild card comes into play. We're talking about AI. And this chart really shows the race we're in. On one side, you have the demographic drag, which is projected to pull down global GDP growth by about 1.1% every single year. But look at the other side. AI could be this powerful counterforce, boosting productivity by maybe 0.7%. Now, that doesn't fix the whole problem, no, but it makes that gap a heck of a lot more manageable. When you look at it like that, AI suddenly isn't just about cool new gadgets or faster chatbots, right? It becomes an essential policy tool, something that could stabilize our entire financial future, a potential solution to one of the biggest economic challenges of our time. And what is absolutely critical here is the timing. Just look at this timeline. 2030, that U.S. worker to retiree ratio hits a critical low. Just 5 years later, 2035, the Social Security Trust Fund is projected to run dry. But then, right around that exact same time, in the late 2030s, is when the productivity gains from AI are expected to really hit their peak. It's this incredible down-to-the-wire race against time where the solution might just show up right as the crisis hits its peak. So, when you think about it, the future of retirement might not be written in old-school financial ledgers, but in lines of code. Maybe it'll depend less on our old models of saving and more on our ability to innovate. The question isn't just about how we slice the pie anymore. It's about whether we can build a much more productive world. So the final question is, are we ready to log in?